Welcome to the People, Property, Place podcast with me, your host, Matthew Watts, founder and managing director of Rockborn. This is a podcast where I share the stories, views, opinions and career journeys of the movers, shakers, innovators and leaders in the real estate industry. Welcome to the People, Property, Place podcast. Today we're joined by Ekaterina Avdonina, co-founder and CEO of Mirastar. Ekaterina set the business up alongside Anthony Butler in 2019 with a vision to create a new pan-European business dedicated to the development, investment and management of logistics assets across key metropolitan areas in Europe. The team's grown rapidly to over 34 people across 5 European offices. And in 2018, BizNow profiled Ekaterina in their top 51 most influential women in UK real estate, calling her the Queen of Sheds. Ekaterina, welcome to the podcast.
Hi, Matt. Nice to see you. Happy New Year again.
Thank you so much. Well, look, I really appreciate you coming into our podcast studio. A place I always like to start these interviews is how you got into real estate.
That's a good start. It's been, over 20 years that I've been doing what I'm doing, not necessarily in sheds, but just in real estate, investing in real estate. I'm an accountant. I'm a chartered accountant and auditor by background. And some of my early clients were real estate businesses, real estate funds. And I was just fascinated by the creative part. I guess back somewhere deep down, I'm a frustrated architect without the drawing skills or without any necessary architect skills. But I like the creativity and the part about, creating areas within cities where we live and making life essentially better for all of the residents in that particular neighborhood. So that's how I had a motivation to go into real estate. My career path started from fundraising background. I started in capital markets and capital raising. I guess that's where, you have to be good with numbers. I was an accountant, so it was an obvious place to start. And that's where I learned how to market products, how to market strategies, how to interact with the investors and LPs. And subsequently, I did a course in real estate. I realized that I have some gaps in my understanding of real estate and the valuation part, and I guess how real estate sits, versus other asset classes, which I had a better knowledge and better understanding of, which I did in 2005, 2006. And since then, I sort of embarked on my full-time, quite diversified real estate career, stretching from being a banker, lender, investor, developer, and now, I guess, operating platform for a large kind of private equity business. So I've been wearing many hats.
Did you have any family or connections to real estate?
So my dad did some real estate at some point in his career, but he was more of an investor. So it was just investment in real estate and, sort of majority investor in large development projects, which I've seen sort of firsthand. So how the 10, 15-year projects can turn up or not. So I guess I had some family experience, but nothing from what I do, and particularly not logistics. This was more of a mixed use infrastructure, real estate repositioning place.
So did he inspire you to go down the accountancy route, or did you go down the accountancy route because you didn't want to get into real estate because your dad did it, or?
No, it's an interesting story. So my family, everyone on my dad's side, they're all scientists. So they're all physics, mathematician, scientists. My dad was a space engineer.
Oh, wow.
In Baikonur, which was where Yuri Gagarin went to space for the first time in 1960s. So I kind of have a lot of space and science backgrounds in my family. And then latterly in his career, he kind of turned to investments and development. But, primarily by heart, everyone in my family are all scientists. So I guess I kind of grew with numbers. The playtime was all, crunching some numbers and learning new laws of physics. This was my spare time. I guess that sort of explained the nerdiness and the affinity to numbers and going to accounting. But yeah, it definitely didn't come naturally, just the creative part, because I was more about everything around the house was all about the law of science.
Right. And so when you were doing your accountancy, were you exposed to kind of quite a broad range of industries and sectors?
Yes, exactly, yeah.
And you just gravitated towards real estate? Is it the tangible aspect or the people?
Tangible, the creativity part, I think just creating, new areas, new parts. I think that was the interesting part of it.
And so am I right in saying your first kind of real estate role was at GVA Sawyer?
Yeah.
So you went in as a project manager?
Yeah, so I was doing project management. I was doing capital raising for that team. We were raising a fund at the time. So so I was it was a long time in the career. So I think the titles were very different back then. But yes, I was doing the mix of fundraising and also managing the portfolio of assets.
And then you moved to the principal side at ING.
Yeah, that's right.
And what prompted that move, or how did that come about?
Good question. I did my studies. I was in London at the time. I was still helping my previous firm with the fundraising. We were doing a lot of fundraising in London. So I was doing sort of part-time studies and working at the time. And I guess I had quite a big network at the time in the UK. And I just came across the ING team. They were fantastic. They were biggest manager investor at the time. And, I guess they just offered me quite an interesting broad career at the time because they had very large development arm. They were best in class developer of particularly shopping centres. Not the asset class we like to talk about these days, but back in the days it was very glamorous. So we were doing shopping centres, we were doing, offices, large towers, but also they had a very big financing arm and a very large, obviously, investor investing on behalf of the ING funds, but also third-party capital. Obviously, that part of the business was subsequently sold and formed CBRE Investment Management. So it was a really interesting team. The job was based actually in the Netherlands, so I had to relocate from London, which was exciting. I didn't know what I was going to get into when I went there. I've only been to Amsterdam before I took the job. The job was actually based in The Hague, in a small town, which is lovely. It's by the sea. It has lots of greenery around it, but it is quite a different lifestyle for 20-plus-year-olds used to living in large cities like Paris, London, and Moscow. So it was an interesting adjustment, but I guess gave a lot of opportunity to think, gave a lot of opportunity to travel, sort of absorb, not getting too distracted from, doing a day job. So it was an interesting time. Definitely a great time. And it was a fantastic business. I learned a lot. I had fantastic mentors. And so only can speak very highly of that part of my career.
You rotated through lots of different divisions, did you?
Yeah, I did. Yeah.
And is that where you really cut your teeth and really built on your real estate understanding from a practical perspective rather than a theoretical?
Yeah, I think, large chunk of my career at ING was during the GFC times as well. So not only we were originating and doing the fun bits at the beginning of my career, but also we had to manage those projects, things that went wrong and during the GFC times. And obviously the business was taking a completely different shape. During GFC, we were splitting the businesses into 3 distinct parts and integrating the lending arm within the bank as one of the bank's products. And the decision has been made to divest the real estate investment management part. The business was called Rhyme. There were a few, potential buyers, so we were also involved with that sale. I think all parts of the business were involved with the sale. So that's what just gave a broad understanding of how the fund management industry works, how the development industry works, and how lending part of the business works. I spent most part of my time at ING within the lending team and involved with both syndications, CMBSs, and just normal structured finance businesses covering different regions. So quite a broad range of transactional experience, which was great because not only you originating and, I guess deploying capital, but you're also seeing the flip side of that, of how things can go wrong. I spent quite a bit of time working with the risk team and the credit team, understanding how they see business. And I think that was the most valuable part of my career. I always tell it to our younger team that risk is the only thing that differentiates investors. Understanding the risk is the only thing that differentiates the investors. Some of them, there are no two people that will see the risk in exactly the same way. So I think to understand how you price the risk, mitigate the risk in a broader sense is what makes you a very good investor.
And so what prompted the move from ING?
Oh, I was impatient. I was 28 year olds. I wanted to conquer the world. I just wanted to do other things. I wanted to do different things. I've always had it in me that I want to set up a business and I wanted to set up a platform. So, I was just itching that it's time to do that. I felt like the, sort of recovery post GFC is the right time and the right time to set up something new. It was very bold. I literally had, 5-10 mentors, managers at ING sitting me down and saying, what are you doing? You have such a fantastic career here. What are you doing? Where are you jumping? What are you jumping into? Okay, well, you have to come back in 3 months when it's not going to work out. But I was very keen to start doing something on my own, working in a very small setup and create something that I would have more impact on. And that's what we did with at the Dallin team. So we met some investors, and Christian Jameson, who was just landed there at the time, was currently CEO in Metropolitan Valor. He and I started working on setting up a new logistics investment management business. So we didn't really have an idea to become shed specialists at the time. We were both, mostly bankers. I guess most of our career and most of our experience for both of us has been banking. But we did believe that there will be a substantial change with the e-commerce and, the whole repositioning and the rise of logistics in the European market. We also like the idea of the fact that, this is the only asset class, real estate asset class, that is so homogeneous. Buying an industrial building in Stockholm is not that much different from buying an industrial building in Spain. If you ignore the legal practicalities of managing and completing that transaction. But in terms of the occupier base, in terms of what are the key criteria for this to be a good building, they all, universal, whether you make an investment in LA, Stockholm, Madrid, or Moscow for that matter. And we liked it. We're very attracted to that because we wanted to stay quite agile and nimble as a business, as a platform. And so have a universal asset class that we could invest to was very appealing to us. And so, and that's how it all started. We raised some capital in 2010 and we started kind of working on on our first investment.
What was it in you at the time that wanted you to go and take a risk like that? I know you said you're 27 or so, but what was it about your psyche or about you that was like, do you know what, this awesome business that is ING, that I've got lots of really great exposure doing some great projects, is great, but it's not enough, or there's something extra that you just wanted to push yourself?
I guess fundamentally, I was not afraid to fail because my downside risks were quite low. I didn't have a family at the time. If it didn't work out, I could go back to a corporate career, but I always felt like if I'm not going to try it now, I'll never try it again because my life will take a different path, and I might become risk averse. So I was itching to do that quite early in my career because I was concerned that, I might not be such a risk taker later in my career. And I guess it paid out. But, fundamentally, I also had a corporate career behind me. I could always go back to take, a different route, different job at the time if things didn't work out with setting up something on my own.
I guess you had 10 people or so championing you at ING, saying you'll be back in 3 months if it fails. So I guess you had the confidence in that. So you met Christian. Can you talk to me about how you set up Dallin and the funding part of that?
Yeah, so we had Christian was already working with a few family offices and a few investors at the time, and he was consulting them about their exposure in real estate and different things. And but the business plan was not there, just investing in logistics was not there. We kind of organically came to this idea jointly. Yeah, it sort of all happened at the same time. It all happened really, really quickly as well. And, I guess, I don't remember some of the exact specifics now, but, we just realized that there would be a good opportunity to create an alternative manager. I think the world was a very different place at the time. We didn't have those mega funds, the big Blackstone funds, the big Starwood fund, they didn't exist back then. And so it was a time for a lot of entrepreneurial managers to try to make, their way in the sector. And there were not a lot of sector specialists. I mean, when we were launching the business, the landscape was very thin. There were not a lot of specialist players. I mean, obviously Prologis was there, Goodman were there, so the bigger diversified global REITs or global developers were obviously there, Panatoni were there. But, in terms of the operating partner landscape, that didn't exist. It was quite a novice thing. And also specialist dedicated managers that would specialize in one single asset class, that was only emerging then. So I guess we were kind of the early single track
investors.
Sort of investors, and we attracted a lot of investors who just wanted to have a dedicated exposure to a specific asset class, which was quite an interesting niche at the time, but a lot of people got burned during GFC by being part of a very diversified fund, and they didn't have control. So I think a lot of more investors wanted to have more control in the investment themes that they're investing in, specific countries that they're investing in, the asset class. So they wanted to be more in control of the investment strategy, and we offered that product to the investors.
And so what was the kind of the business model at the time? Was it just operating partner with kind of a couple of different larger LPs that had dedicated funds rather than a commingled vehicle?
Yeah, it was more of a sort of separate account JV structures at the time, and sort of then latterly it formed into something more institutional. But yes, we started with a large allocation from a large family office, which was very meaningful for the first-time manager. We raised 200 million for, first-time managers, first-time platform. It was quite significant. We had to give away the control platform as well, just in case things do go wrong. The investors understandably wanted to see some control. And yeah, we started going. We deployed that capital. Get an upsize, get some good refi, grew that initial vehicle to 500-600 million, and then we raised more, diversified our risk, and went up the risk curve. So started doing some developments, some value add investment. At that point, Christian left the business to set up Valor. And sort of I was running investment. The way we sort of split the roles, Christian was in charge of the capital raising and investments, dealing with investors. And I was in charge of all the deployment of capital and all the investment activity in our investment strategy. And when Christian left, I had to combine the two roles. But there's only so much I could do in a combined role for a period of time. And then Anthony Butler, who is my current co-founder in Mirastar, he joined Dellin. That's how we met. So he came to Dellin to take over the investment part of the business and I guess institutionalize the processes and help with the leadership of the platform. And sort of the rest is history.
And so you kept building that out further?
Yeah, we kept building it up. So we grew from sort of two of us in 2010 to when Christian left around 2016, we were probably 15, 16 of us. And then when we left Dellin in 2019, the business was 44, 45 people. So, and with three offices, so it was a pan-European platform as well, 3 offices, and we had investments in 4 countries. Just didn't have an office in Germany. We're managing Germany out of the Netherlands. But yeah, we grew multiple clients, multiple investors. So it was an interesting times. And I think, logistics at the time was sort of gaining its momentum, But, obviously we didn't know what COVID is going to do to the sector and how it's going to sort of really rise to the levels I think no one ever anticipated. But definitely I never anticipated logistics yields or values or deployment volumes, in terms of investment transactions will get to the level as they got to in 2022 when we were setting up our original business plan in 2010. I think that surpassed any of my expectations, which is obviously fueled by, the rise of e-commerce, but also what happened during the COVID pandemic and, the fact that we were all locked in our houses for, nearly 2 years and, exploring our devices and exploring how to live our life from the comfort of our kitchens and studies. And I think at that point, the adoption just, went through the roof and obviously which helped dramatically our business and our strategy and the reason, frankly, why we've been growing so much as a company.
So you left Dellin and set up Mirastar. What was the driver behind that and how did that come around?
Yeah, I think, first it was an interesting time. So, we definitely saw a possibility to push more. And, as I mentioned, we had to give away the control of the platform in 2010, Christian and I think it was, I guess I just wanted to control something by myself and be more in control on the operating decisions, which we could never do within the setup that we had at Dellin. And, I just felt like it's time to really step out of my comfort zone. I guess, when I did it back in 2010, I guess the striking difference between 2010 setup and 2018 setup, back then it was a really easy decision because, as I said, the downside was really well covered. In 2018 and 2019, when the decision was made to set up on my own, there were a lot more risks at that point. And I think that made it a lot more interesting. I guess because one venture kind of succeeded in its own merits and in my own eyes, that gave me comfort that stepping outside of the comfort zone again will be the good thing ultimately and it will work out well. But I had to massively back myself, particularly because I was 5 months pregnant at the time.
Wow.
So I realized that obviously I have to combine the motherhood and setting up another business at the same time. So I always say that I have the twins experience. One was the physical and one was my mental twin, but equally both were very time consuming.
I was going to say, you're not work shy, that's for sure.
Yeah. So I think that was an interesting experience and obviously, but I guess it gave a lot of strength to be efficient about the whole setup, to be programmatic about all of that. And I guess, ultimately it helped that it was my second time that I was doing that. So, the sort of the rule book of how to set up a property company, I had it somewhere in my head.
I bet, yeah.
Yeah. So,
and also you weren't 27, right? As not an unknown, but as a first venture, you could probably be a little bit stronger in terms of negotiations on those term sheets with that.
Yeah. No, I think obviously you have more confidence. I think it's experience. A lot of things about experience is that you just gain confidence. You just gain confidence that what you're saying, what you're thinking is somewhere in the middle of the truth. When you're doing it for the first time, you just don't know. And I guess that's, it just doesn't give you enough confidence. But when you've done it before, it just gives you confidence that it's going to work out and, you're doing the right thing. And ultimately you'll do the right thing to the investors. You'll do the right thing for, your employees as well. Because the striking difference between Mirastar and Tallinn was that we had a team. I had a big expensive team day one. So, it's a lot of responsibility. I think it's not, when you're just responsible for yourself and you're selling something on your own, it's one thing. But when you have to pay checks of other people who step out of their comfort zone,
take a risk on
their jobs and take a risk on you, I mean, that's just really gets adrenaline running through your veins. But, again, you just, you kind of one step at a time, and ultimately you get somewhere.
And so am I right in saying that you were in Ibiza having a beer, or maybe not, as you were 5 months pregnant at the time with Richard Croft, and that kind of relationship came around and discussions flowed and kind of Mirastar came out of the back of it? Or
yeah, I mean, there were no beers consumed in Ibiza with Richard, but Richard is a dear friend of mine for a very, very long time. I love him dearly, and he's always been my, dare I say, mentor in the industry. And so obviously when I had some ideas around the setup of the platform, Richard was one of the first few people that I called with this idea and asking for his advice. And in classic Richard Croft's manner, he said, "Of course." And yeah, M7 team at the time were going through quite a bit of transformation in the business. They were not owned by Oxford Properties at the time. And M7 are very avid investor in smaller businesses. And, they're big venture capitalist investor as well as they are as well known they are as an investor in real estate. They also back a lot of people, and over the years they've backed so many successful businesses that I think it will probably take us an hour just to talk about all the businesses M7 were involved with. So I think naturally when we presented them the business plan around the formation of the platform and what we had envisaged, down the line, and why we believe there's room for another manager in industrial logistics in Europe, I guess it sparked interest in M7's eyes. I mean, they saw it as an interesting venture capitalist investment. I think ultimately they believe that there will definitely be room for another investor to buy that platform at some point. So they felt that the investment is safe. But yeah, it's just it went so well. I mean, I could not praise them more, and I could not praise more that experience we had with working with M7. They provided all the operational support and everything the young business needs. Because when you're setting up a company, all you think about is how you're going to make your investment case work. But then you sort of confronted with the compliance part and the accounting part and the finance part and opening a bank account. Oh God, don't get me started on opening a bank account. And, and then suddenly, as a leader, you're no longer thinking about the investment strategy. All you think about is, dealing with the operational challenges of running the business. Working with M7 enabled us to really focus day one on what we were meant to be doing, on our core parts of the business. And the infrastructure within M7 allowed us to kind of tap into that, tap into different divisions of M7 and not worry about, doing it for the first time as a new business, which I guess saved us 2 years of operational kind of burden as a company and really enabled us to set up a very well-formed, very institutional manager from day one, which is quite a rarity. And most importantly, it enabled us to scale quickly. And I think that was the key learning point for me setting up Mirastar versus setting up Tallinn, is that ability to scale and the foundations that you need to lay in order to be able to scale is so important for successful transition, for successful growth, because I've seen it far too many times how, fast growing businesses then fail on something trivial, and we were very keen not to do that. And I think, I think having that experience of doing it one time just enabled us to go like, right, okay, this is what went wrong last time. We definitely want to do it this time this way. And most important, the question that was still in front of all of us, and what we're trying to solve is, how do we make it a scalable platform that can manage, 5-10 billion of assets in a short period of time? Because we knew that the ambitions of the investors that will be working with us will be to get to that scale very quickly. And first and foremost, it was investing in the best people. I guess our criteria for recruitment and the testing and the processes we set up on onboarding new people were incredibly stringent, and we didn't want to sacrifice quality in the platform. And then it was all about reinvesting a lot of capital in the platform, in making sure our onboarding of the assets is going well, the IT infrastructure is going well, the model parts is going really well, and of course the accounting, the data collection is robust and also best in class.
So was there a conflict with M7? Because I know they had a lot of multi-let industrial across the UK, but they also had a couple of other mandates across Europe. Was there a particular conflict,
No,
or were you had a particular investment thesis, or you're going after a particular type of asset that just wasn't on their radar?
No, we didn't come across any conflicts. I think we've all understood what different parts of the business were doing, and they didn't last too long. I mean, we set up a company in 2019 together. By April 2020, we sold the business, so they stepped out of the business as investors in the company. So it was only for a year they were investors in the platform. So we didn't come across any conflicts. And if I would imagine that even if the conflict would arise, we would deal with it like, in any other big institution. Two fund managers would deal with the conflict. It would be some form of rotation measure or just a conversation about how you deal with it. But no, we didn't have. It was blissful. It worked really well. We learned a lot working with them. And, ultimately, they, that joint venture and that corporation enabled us to set up a very good business. And we are always very, very grateful to M17 for allowing us to and supporting us in making that happen.
And how did the relationship with KKR come about? Because they've got unbelievable amounts of firepower and a lot of drive that you just alluded to. How did that transition come about?
Yeah, so we've met KKR team when I guess they just popped as a real estate investor in Europe, and when we were still at Delin. But there was no scope to cooperate because I think they were still evolving their themes of investments, and there was just no room for cooperation. But we knew each other, and Anthony was former colleagues with one of the KKR senior members of the team. So that's how we had also sort of a personal relationship there. And yes, we've done a joint venture together in 2019, bought some assets in the Netherlands. And,
we realized it's working really well, and we enjoy the cooperation. We enjoy, doing deals, analyzing, underwriting, traveling together.
It was all very organic. And, KKR very quickly mentioned to us that, they have bigger ambitions in the industry. They have bigger ambitions in the sector. They would like to do more than just that specific joint venture. And whatever would be interested to be their partner on this European logistic journey, which, we gave quite a bit of consideration. And we realized that the ambitions in the sector are quite big. But also, I think the fundamental driver for this relation has been around the way we saw the risks I mentioned earlier. Because it's quite rare to meet two sides of the business, the manager and the investor, who see the risks and the creation of, the platform and the portfolio constructs in a very similar light. We've tested quite a bit of different themes and sub-investment strategies with the team. And every time we realized that we are very aligned in the way we consider something to be a risky investment and what they consider to be a risky investment, which is a very important point in anyone's relationship. Because if you have a really big divergence of views on how you see the risks or how you want to mitigate the risks, it's pretty doomed in my experience of how things will work out, because inevitably at some point you're going to end up in the correcting market and the recession, and then everyone is looking for shadows, and everyone is looking for more risks at that point in time. And I think it's important to have this sort of holistic, bigger picture view between both parties. And I think, on the personal level, we shared a lot of values, the KKR team do. And, they obviously a very large global player, but, they value relationships, they value integrity, they value respect, and they're a very trustful partner. And all of these qualities in them as a house in the business were very important to us. And we realized that those foundations of their corporate culture are not dissimilar to Mirastar's corporate culture. So we saw a natural fit. And so we formed this relationship in April 2020. So we finalized the relationship. So M7 team stepped out of the joint venture of the platform, and KKR came on board. So they effectively stepped into M7's shoes in the platform.
So they bought a stake in the platform and then provided the equity as well.
Yeah, exactly. And they provided the equity for future growth. And so the rest is sort of history. We've sort of done a lot together since then, mostly from our sort of studies and kitchen tables and spare bedrooms. A lot of it was pandemic. A lot of it was during the pandemic. So we had to grow a lot and expand internationally and set up offices during the pandemic, which was quite an interesting experience. First time closing on a loan when the lender has never seen the asset, or first time closing on something where we just physically couldn't get there. It was interesting times.
With a daughter as well. No
yes,
doubt.
with the chairman. She's our chairman, with my daughter, who is obviously very adept in real estate investment by now, after attending so many different calls. But it's been an interesting time. We obviously didn't see that coming. When we completed our position, when we completed our deal in April 2020, we didn't realize that for the next year and a half, we're going to be in this series of very long lockdowns, and we're not going to be able to even see each other for a long time. Even though we're all based in London, and we could just normally just walk to each other's offices. So it was a really welcome boost to everyone's morale and activity when in 2022 or late 2021, early 2022, we could finally go back to normal way of doing business with normal meetings and the social interaction, which, as you know, is very important in our industry, and a lot of it was lost during the years of pandemic.
So can you just give me a bit of an overview of the business at the moment, the assets under management, and some of the deals that you've done?
Yeah. So we're in 5 offices. So we got an office in Stockholm, Milan, Madrid, Amsterdam, and London. And as you mentioned, we're about 34 people. And there's some growth plans for this year. So we'll probably get to 40 at some point in the next 12 to 18 months. And, the assets under management is an interesting point, because I can tell you the assets under management Q1 next year. At the moment, I don't think anyone really knows the true value of their real estate portfolio. So it was, as of last year, Q1, Q2 last year, it was in excess of 2.5 billion.
Vast. So you guys have sprinted really quick.
Yeah, we did. We scaled very quick, and we've done a lot of deals. It was in excess of 40 transactions that happened in that period of time. We've also exited some assets in the first half of last year. It's amazing how fast everything's moving. So we've done buy sales. We've developed a lot. So we've created a lot of stock. And most importantly, we leased a lot of space. We did quite a bit of letting activity in this period of time. So it's always been incredibly transactional, the business. So I think late last year, and what happened in the markets and the sort of standstill that happened in Q3 last year, obviously was a welcome break from a very long marathon that we were on as a business.
How important is it to set up local offices on the ground in Europe rather than run everything from London?
So we're quite an unusual setup. So I know there are 2 schools of thought normally in the pan-European investment management houses. One school of thought is to have everyone on the ground, so the investment people, originators, finance, asset managers, developers, everyone on the ground, and effectively you have lots of mini companies within the one large company, and then you have HQ and boards sort of running all of that. Or there's another school of thought where local offices just do local origination or local support function. We kind of neither one of them. So our local offices, we have very senior country heads that's sort of in charge of our business on the ground. So of course they originate, but their primary function is to make sure they're carrying the flag well, and they transact, they oversee, and most importantly also manage the existing relationship with the occupiers and with the overall community. But also we have on the ground our development team, technical team, and also asset management leasing team. So all of that is on the ground. Our investment team and people who support the transactions, and everyone in the finance team, and everyone sort of in the headquarter functions, everyone is in London. So we have created effectively centers of excellence within the investment team, asset management team, development team, and finance team, all based out of London, that oversee the activities on the ground. And then, of course, we have all the local supports and all the local day-to-day activities run out of the countries, and they are essential. I'll give you a few examples. I mean, obviously development will be one of those. We wouldn't be able to oversee efficiently a construction of any of our developments without the local team, because as 9 out of 10 things will go wrong, particularly they will go wrong during the foundation phase, so early on in your development. So to have something on the ground who have this constant dialogue with the contractor, with your project management team to try to solve the matter and speak in the local language and understand the local practicalities is, absolutely essential.
Rather than having lots of different operating partners on the ground, with different views and approaches and processes, and try to coordinate it that way.
Yeah, no, for us, it's not the way we run the business. I mean, we get a lot of value from setting up the processes and our specifications, the way we run our marketing with our buildings, that it's all coordinated across Europe, and we get a lot of consistency in different markets. So of course, we do the things the local way, but there's a branding consistency and specifications consistency across different markets as well, which is sort of embedded with more of our company-wide principles. So for example, we have very high ESG standards as a business. And for us, undertaking a development project in Italy or Sweden or the Netherlands, the standards of the quality of what we want to build in terms of ESG credentials of the building, they will not be in line with the local regulation. They will be more with the highest standards possible in European regulation. So I think if you work and you have more of a localized approach and you work with a series of local partners, you wouldn't be able to have that sort of consistency across your portfolio, which we can push on because of our sort of pan-European footprint, but also because we have pan-European ways of doing business.
And is that driven from an ESG perspective? Is that driven by an investor, or is that driven by occupiers, or both, or just an ability or a desire to kind of contribute and do your part as well?
It's a very good question. And I would give you a different answer if we were sitting down in the summer or now. I'd say in the summertime, it was mostly driven by LPs in the funds, that sort of drive to the, rationalizing your networks, trying to build and occupy the buildings of the highest quality. It was, primarily LP driven because of the, European directive and the requirements of a lot of large institutional investors on their new investments and new allocations. But there's been such a big shift in the occupier community since last year, since the war started, because obviously energy and electricity costs have risen to 5-10-fold, depending on the nature of the occupier's business. And, and so this focus on ESG credentials of the building became really important for all the occupiers we're dealing with. And we're not only dealing with large corporate occupiers, we're dealing with a lot of smaller occupiers because we have quite a large light industrial platform within our portfolio. And so we also have a lot of smaller businesses, which, ordinarily wouldn't really care about the green credentials of the building, but because they now understand the correlation with the credentials of the building, with the running operating cost of that property. It's not anymore theoretical to point to them. They really know the impact on their running bill and their running utility cost. So, that's sort of, I guess, our philosophy is now paying off quite dramatically, because we were quite a strict investor with ourselves, in 2000, because when we set up the business, we wanted to do everything in the right way. And I guess that helps you when you're sort of new kid on the block. You can create strategic objectives and you can create your business principles from scratch. And, high ESG credentials was one of the most important things, and high sustainability and ensuring that we are offsetting a lot of carbon that we produce was really important for us as a business, to do good by the community and by the environment, and above and beyond what we need to do. And so since kind of last year, we've really seen the shift. And now I would say it's for the first time I'm seeing there's also impact on liquidity in the market, depending on the ESG standards of the property. And that shift happened so quickly. I would say, whatever liquidity there is now in the market, obviously it's a lot more scarce than it would have been Q1 last year. But whatever liquidity there is there, one of the key criteria for any investor looking at a new acquisition would be, what are the ESG credentials for this property? And the lenders are taking also a much stricter views around the, stranding of the properties, not only being compliant with the minimum local regulatory requirements and whether this building is going to be with the right EPC rating versus the local regulation, but it's more about, are we inheriting, are we buying, are we financing the building that is fundamentally not going to get stranded and not going to be, non-operable from an investment point of view or from, very changing regulation point of view. And I think that is just such a dynamic shift in the market. And there are a lot more conversations happening about that now, which is quite an interesting development.
That's great to see. There's been a lot of change in the market in the last 6 months or so. Can you just give me a bit of an overview of what has happened in the market and the shift and maybe the opportunities that have been presented?
Yeah. I mean, I think by now, we all kind of made sense of what is happening in the market. I think when everyone forming their business plans early part of last year, everyone knew the interest rates are going to rise last year. The writing was on the wall. It wasn't a real surprise to anyone that the interest rates will need to start rising, given the inflation figures that were coming already in Q4 last year in some parts of the world. But obviously the war, had a clear direct impact on the rising inflation, rising energy costs. But I guess what took the market by surprise, and I think the reason why we've seen such a dramatic drop in the values, is that I don't think no one quite anticipated how quickly the interest rate rises are going to happen. I think, like with everything in life, you're anticipating a more smoother transition. But as with everything in life, it normally comes in shockwaves. And I think that shockwave paralyzed the market. Investors were looking at their, portfolios, particularly in the listed space, which were losing 30-40% of the value essentially overnight. And, that led to a paralysis in the market because no one quite figured out what would be the floor for the values. And, some sectors obviously had a lot more fundamentals and had stronger fundamentals. And so a lot of sellers pulled back their stock in, hoping, anticipating there will be better times to sell the assets. So we didn't see any distress. And I would say the other difference to this downturn comparing to, GFC downturn would be that there is liquidity in the market. There's a lot of liquidity in the market. Undeployed capital that could be targeting European real estate and in particular European industrial and logistics industry is vast. I mean, we're talking about, some agents estimate in excess of 100 billion of capital. So I don't think this time around the problem is liquidity. The problem is bid-ask spread. For a long time, since last year, we've had a lot of bid-ask spread issues between what the willing sellers were prepared to accept for their product and what the willing buyers were prepared to pay based on the curve of the interest rates, gone are the days of negative leverage. But I think it's sort of now starting to settle down. I think the inflation figures are coming down quite rapidly. The monetary policy implemented by most governments is working. And so I think we are looking at a curve where, there probably will be a few more interest rate rises this year, but, it's very likely that it's going to come down in 2024. And that gives a lot of people a lot of optimism. And generally, real estate people are very optimistic. That's just the nature of the beast and the nature of the crowd, because you have to when you're working on a 7-10-year business plan. I mean, look, if you are all doom and gloom, you don't want to be all doom and gloom for 7-10 years.
And writing big checks as well. That's not a good combination.
Writing a big check and then waiting for whatever's going to happen in 7 to 10 years. No, look, it's not for hard faints with this industry. So I think generally we're a lot more optimistic as an industry than, let's say, the hedge funds. So I think a lot of that is also driven by the cycle and the psychology of the industry. But I think the consensus is sort of there. It's likely to be a milder recession, this one. And, it's likely we're going to see already a decrease in interest rates quite rapidly next year, which gives a lot of confidence to some, more core investors to potentially come back, late this year or early part of 2024. but at least it's not anymore the paralysis and the standstill as we had last year.
So there's kind of room for optimism in the market right now?
Yeah, I feel like the air is changing. In December it was all doom and gloom. I'd say anywhere in any kind of big CBD in any European city, December pre-Christmas run was all doom and gloom. I think normally it's obviously the time of the year when you're just knackered. But the adrenaline from different transactions that everyone needs to close, and the year end is always that deadline, just kind of keeps people going. This time around, there were no real deals happening. So I think the adrenaline was not there, and everyone was knackered, and it was all doom and gloom. So the mood was definitely not great. And so the long breaks and the long Christmas time off with a lot of food definitely helped the morale of most people in our industry, and they came back more joyful and more optimistic. But obviously the most important part of all of that is that the data, Q4, December and January data, is looking promising from a macro point of view, that it's working, the monetary policies are working, and it gives optimism that maybe we don't have to go all the way on the interest rate rises. And most importantly, people see the path for decline and some sense of normality, what it could look like. I think the biggest unknown now is everything about the occupational markets, but at least the capital markets part is a lot better understood by a vast amount of investors.
What do the next 3 to 5 years look like for you and Mirastar?
I think this year it's an interesting one. I think we're going to see a lot of interesting opportunities. I think it's going to be a slower year. Well, everything comparing to 2021 and 22 will be a slower year. Just looking at the investment volumes that were transacted in 21 and 22, I think those were unprecedented. We're going to see less transactional activity in European markets, but it will be enough interesting stuff to do. I think it's time to really focus on your portfolios. We're spending a lot more time now trying to improve ESG, or what we haven't even thought about improving. So there's a lot of initiatives within our portfolio about what else can we do to improve the credentials, the green credentials of our building, which is quite creative and innovative. And there's a lot to do from a repositioning point of view on our portfolio, extending leases and, adding some strategic asset management, which is going to keep us very busy. And, I do think there will be some interesting transactions in the market as well, because obviously not everyone is very well capitalized as a seller. Naturally, some people will have to refinance, or some people will have to just sell because the investors are pulling the plug, so we think there will be some special situations. I don't expect a wave of distress or, kind of generational opportunities coming to the market, because there's just still enough liquidity. And, I think banks are healthy this time around. The banks' LTVs are healthy. So there's not a lot of catalysts for big distress opportunities, unless there's some structural factors. So it's going to be mostly, looking inwards and some transactional activity. I think 24 is going to be very interesting. And I think 25 will be even more interesting. And I do even expect some, strong competitive tension, because investors are not given a lot of choice of where to deploy their capital sensibly and at scale. And, they're not, the offices, which obviously form such a large part of anyone's investment portfolio for a long time, obviously they're not in vogue. Bifurcation that happened in the sector is not to everyone. Some people do buy in the story, some people just don't, and that's okay. But I think most importantly, everyone is already allocated to offices. We don't have a lot of investors who go around the market and say, we are underallocated to offices. Everyone has a decent allocation to offices. What they're not allocated to well enough is to alternative sectors, and most importantly to residential sectors and, different shapes and forms of living sectors. And of course, the industrial logistics. Everyone is underallocated to the sector because of the barriers to entry. So I think that will lead to some form of a competitive tension. So I think, we as a business that is solely focused on one sector, our business plans and what we're going to do is
following the same path
as what is happening actually in the market.
We're building on it further.
Yeah.
What's the best piece of advice that you've been given in your career?
I think it's really back to basics. Do not assume you know everything, dig deeper, always don't let ego come into play with, different decisions that you're making. I think that was always the best advice, but it's not even advice. It was just more of a repetition of the same advice along my career from different people to, stay humble, assume you don't know everything, and just kind of keep your head down, in the sense of like, just do the right thing by everyone. I think it's very easy to get carried away in this industry with, different things, your performance, the media attention, and everything else. And I think it can affect everything. And most importantly, it can affect your interaction with other people in the industry and also with your team. And I think staying humble is just probably the best thing anyone can do, whether it's in work or in their private life.
Yeah, I really like that. What's been the biggest learning of setting up Mirastar, setting up the business second time round? What's been the biggest learning from that experience?
That I didn't know that I can survive with 1 hour sleep for very long periods of time. Not something that I would recommend to repeat to anyone, to be clear. I think the biggest learning will be always been not to underestimate how important it is to get the best quality team. And the people who have the same values in how they want to do the business or what is driving them in life. If you get a room of people that share the same views, but not views about, doing their job, it's more about their life views. They're driven by the same values in life and they're driven by the same ambition in life. You can do amazing things. You can really do amazing things. You can do things you never thought is going to be possible on paper or outside of any paper or anyone ever told you about it. But if you get this room of people and everyone is thinking in the same direction and they share the same sort of almost like wiring, you can make some amazing things. And I've seen it with M7 team as well. They are very much a very well cohorted team of people with very similar values. And, they're doing amazing things. So I think just having that sort of uniquely different team, but fundamentally sharing the same values is just so it's just magical.
That's the secret sauce.
I think it's just magical, but it's like with everything else in life. I don't think you can sort of divide your private life to your work life really that much. It's all driven by the same values. It's just values
and life, and it's all intertwined.
It's not rocket science, as I know a lot about it based on my family.
Well, bringing it back to that, exactly. As we draw to a close, a question that I ask everyone on the podcast is, if you're given £500 million worth of equity, who are the people, what property and which place would you look to deploy that cash?
I would take up the bet on investing. We would invest that as a team. I think European industrial logistics is still, has a lot of value, and I think the values have dropped. So I think it will really offer a very attractive return. So I would deploy this capital carefully over the period of 2023-24 and create a diversified portfolio of quality infill properties or big box properties closer to urban conurbations in core Northern European markets.
And who are the team, or who are the people, or is there anyone that you'd look out, kind of old mentors maybe from ING that you would have on board as well as your existing team?
I think a lot of people that I work with at ING, unfortunately, by now retired. So they're all more into gardening these days than into deploying capital, advising people. But I think, we have a lot of growth and advice within our KK Mirastar relationship. So I think we'll just keep it close to ourselves. We're not going to kind of try to destroy the existing setup. So I think we will just continue deploying capital within the existing team. Within
the existing infrastructure that you've built and worked so hard on. Well, look, thank you so much for joining me and sharing a little bit about your career journey and what you've done at Mirastar. It's been amazing to play a small part in what you and the team have done. And I'm excited to see what 2023, 24 and 25 and beyond look like for you.
Perfect. Thanks, man.
Thanks so much. Thanks for listening to this episode of the People, Property, Place podcast. If you found it insightful, feel free to share it with a friend or colleague, subscribe, give us a rating, like or comment. It helps tremendously. It'd be great to hear from you on LinkedIn. I'm super open-minded to recommendations of which guests you think we should get on the podcast or areas of the market that we should explore further. So do drop me a message. The People, Property, Place podcast is powered by Rockborn. The team recruit experienced talent for real estate private equity firms, investment managers, REITs, property companies, and advisory firms across the investment, asset management, development, fund management, ESG, cap markets, investor relations, and general practice space. So if you're considering your career options at the moment or looking to attract top talent to come and work for you, head over to the website www.rockborn.com, where you can find a wealth of resource to aid your search. Have a great day wherever you are, and I look forward to catching you next time.